This 3 point framework from Stan Druckenmiller is one of the closest things you'll see in stock market to identify a potential stock market bottom. His teachings are very similar to William O'Neill and Stan Weinstein, the only difference being that he adds and takes into consideration the macro of the economy and what the Fed is doing. So just stick a bit. I'll just show you how you can integrate the teachings of Stan Druckenmiller along with William O'Neill and Stan Weinstein to potentially identify, number one, when the market will bottom, and number two, what do you do when the market potentially forms a region where it is starting to reverse. So welcome back to another weekly update, guys. Keep your notifications on for future updates, and the comment section is open. Make sure your comments come in today, that is Saturday. I'll certainly reply to all the comments that come in today. So the first part we'll begin with is the macro picture and why this is important. Within the macro, Stan pays attention to 5 subpoints. Number one, FRP, which is the Federal Reserve Policy. In Indian terms, that would be the policy set by the Reserve Bank of India. This includes interest rates, money supply, and quantitative easing or tightening. The second is LC, which is liquidity cycle. How much capital is flowing into or out of the market. The third is EI, which is economic indicators, which is generally the GDP data, the IIP numbers, inflation trends, unemployment data. The fourth is bond yields and interest rates. In general, if the yields peak out and start dropping, that is when liquidity starts coming back into the stock market. The fifth is MS, which is money supply growth, which essentially falls into the liquidity cycles. It basically tells you whether central banks are printing more money or not. If central banks generally print more money, that is when you see a lot of liquidity coming back to the stock market, and it leads to a new bullish cycle, or the existing cycle gets a lot of fill-up on the upside. So now that you have a basic understanding of this, let us move to the next point, which is liquidity drives the market. Once I'm done with the basic framework of Stan Druckenmiller, I'll then tell you where the Indian market is today with respect to the bottom, or whether we are going to see further correction in the market. So Stan believes that liquidity is the most important factor in the market. During bear market, the tightening of liquidity happens, market drops as the Fed raises or reduces money supply. If you remember the cycle of 2022, this is when US markets started to correct, mainly because back then Fed started raising rates aggressively from 0.25% to something like 4.5% by the year end. Rebound, which is the bull market. This is usually when liquidity expansion happens. Markets recover when central banks inject liquidity into the system. Sentiment can delay a rally, but this is a recipe of bull market. So according to Stan Druckenmiller's framework, liquidity is the key to stock market. If you look at the all financial crisis that has happened in the world in the last 25 years, you will see that the seeds of the bull market have been sown when the massive correction was going on in markets. In 1999-2000, when Nasdaq formed a top and started falling, in between 2000 and 2002, this is when Fed slashed interest rates 11 times, bringing the Fed rate down from 6.5% to 1.75%. Mind you, the rally did not happen immediately, but the seeds were sown of the next bull market that began in 2002. In 2008, when the global financial crisis happened, this is when by December 2008, Fed again slashed the interest rates to near 0%. That was 0.00% to 0.25%. Now, this was meant to reduce borrowing cost and simulate economic growth because loans are more easily available. Again, if you see that the rally did not begin immediately, it took another 3-4 months for the rally to play out in the system. In 2020 COVID meltdown, in March 2020, the Fed again slashed the rates from 1.75% to 0.0%, 0.25%. This again made borrowing cheaper, and it again simulated economic growth, and we had one of the most amazing bull markets that played out from the bottom of COVID. In 2022, if you remember the cycle that I was speaking just a bit earlier, this is when Fed started raising interest rates aggressively to 4.5%. And that is why US went into a 12 to 14 month kind of a correction. And then when Fed switched its stance again in 2023, when Fed started cutting rates gradually, that is when the bull market again began in the US. So Stan here is absolutely right. It is the Fed or the RBI that determines the liquidity in the system, and that gives birth to the next bullish cycle in the market. It may not play immediately, as I've written here, it gets delayed some bit, but that usually is the phase when markets begin bottoming out in a span of approximately 4 to 8 months. Now, during a bear market, there is a template that Stan follows. He rotates his money into high growth assets at the right time. So there are three broad categories that he looks at. Number one, technology and innovation. Number two, disruptive business. And number three, companies with strong balance sheet. When it comes to technology and innovation, he's always looking for companies with secular growth trends. Now you have to watch a couple of my previous videos to understand what is a secular growth trend in a company, what is a strong balance sheet in a company. This I've covered in detail in the last two videos. I'll link it in the comment section below, and I'll also link it up here. So he prefers new leaders as opposed to stocks that have worked in the previous cycle, because he, along with William O'Neill and Stan Weinstein, have always maintained that bull market needs fresh legs to run on. The stocks that have performed earlier rarely come back and make new highs as the market attempts to bottom out. The second category is disruptive business. This is where India has an edge because you're seeing a lot of new age businesses getting listed. These are stocks that are going to dominate the next economic cycles or the next many economic cycles, because they are changing essentially how things have been working in India. And this is where you see explosive growth happening. There are a lot of new age stocks that have listed in the last 2 odd years. Just go to the IPO list and find out those names and see which companies you understand and use on a day-to-day basis. The third, of course, is strong balance sheet. This is something I won't repeat because last week's entire episode was based on this. Move forward, I'll just show you Stan's current portfolio and how he's positioning himself in the challenging times ahead. Remember, on one hand, we have someone like Mr. Warren Buffett, who is sitting at an all-time high cash level. On another hand, we have people like Stan Druckenmiller, Jim Roppel, and other legends of the market who are maintaining their positions but have made subtle shifts to it. So this is the current portfolio of Stan Druckenmiller. He's outperforming S&P 500 by a huge margin. S&P 500 for the year is down about 3%. He's still up 20%. Of course, the recent fall in the market has affected his portfolio as well. But if you look at his positioning is largely in the mid to large cap space, somewhere in the middle. So companies that have the potential to become large cap and mega large cap. And in the mega large cap category, he has limited exposure. So the bulk of his exposure sits right in the middle, where he has gone behind growth stocks, where he has added into some growth sectors. He has reduced some, as these red bubbles are visible here. The detailed list, if you want, I'll put it out in the comment section later. But his positioning is very clear. In a little bit of uncertain times, he has made a shift from small caps to mid caps to something like mid to large cap. And this is seen in his performance. Over the last 4 odd months or 6 months, when the global markets have been relatively fine but volatile, his portfolio has held up really, really well. And this is a trend that we are seeing in India as well. The SMID space, small, mid, microcap space, is being butchered on day-to-day basis, but it is the mid to large cap space. If you hold stocks there, you'll still manage to find out a lot of names that are holding up very well in this market. So now that you have a basic understanding of Stan's framework, let us now move to the next section, where how he anticipates a potential bottom in the market. Remember, he's looking for the macro data to align, but then he looks for technical reversals and overall market breadth to time his entry better. That is why I've named this section as waiting for the right sentiment shift in the market. The first is Fed and RBI pivots. That is what he calls it. It's the Fed pivots basically, but because I'm making this video for the Indian audience, this is the RBI pivot also. When the central banks tighten monetary policy, that is raise interest rates, bear market usually forms in the market as the liquidity dries up. When they loosen monetary policy, the market finds a bottom and begins recovering. Now you have to ask yourself where we are in terms of this cycle. Whether finally RBI is tightening liquidity or easing liquidity. This is something that has been abundantly clear in the last 3-4 months where the RBI is heading, and that is to inject liquidity in the system. So when the Fed signals a pause or a reversal in rate hikes, it is a strong buy signal for him. But the next step is technical reversals. He always waits for technical confirmation as higher highs and stronger volumes come in the market. He prefers to check this on a higher time frame. You have to understand that Stan does not have a book from where I have understood this. I watched a lot of videos that he has done, the interviews that he has given, and from there I have made this framework, put all the essential points together. Pay close attention to market leadership. That is, he's always looking out for which sectors are taking the market higher. There is one interesting point that I found in his videos, that is, when he looks for a bottom, he's always looking at the VIX for guidance, whether VIX is spiking or not, because this is the point of extreme fear. And this is what signals a turning point in the market, because with the spike in VIX comes the market bottom. The last is the market breadth. He's looking for how many stocks are moving up and exhibiting the same price action, that is, higher highs with stronger volumes. He also pays a lot of attention to the quality of earnings coming through, which is analysis of quarterly earnings based on the leadership that he is spotting here. Which stocks are moving higher on strong volumes? Are those similar stocks giving strong quarterly performance in terms of earnings? And the last point here is about flexibility. If he sees that his thesis is wrong about Fed pumping in money and a potential bottom getting formed, he quickly cuts his losses and then again attempts this as the market gives him new indications. So when it comes to identifying a potential bear market bottom in India, or rather timing the market in bear market, you need to follow 4 points based on Stan's analysis. Number one, follow the Federal Reserve, which means follow the Reserve Bank of India. If the Fed is tightening, stay defensive. If RBI is tightening, stay defensive. If they pivot, look for buying opportunities. You have to ask yourself, is the RBI tightening? Should you stay defensive in the current time? See, the answer for me is pretty clear. I'm looking for buying opportunities. There are many buying opportunities in the market. Am I optimistic about making a lot of money? No. Am I mindful of the fact that there are going to be several whipsaws along the way? I'll have to cut positions, sit on the sidelines, again attempt to build positions? Yes. But am I going to have a myopic view of the market and short sell for the next 3-5%, or maybe when the market rallies another 4-5%? No, I'm not going to do that. I'm not going to do that because in my mind, I'm very clear that RBI is out here to support the Indian economy in terms of growth. Everything that they are doing in terms of cutting interest rates, injecting liquidity in the system, this is going to sow the seed of the next bull market. If I deviate away from the process of attempting to buy stocks that are moving up, sectors that are showing leadership, then it is only a matter of time that the market will have a runaway rally and I'm going to miss that rally by sitting on the sidelines or attempting to short sell the market. Watch for the bottoming out process. You have to look for institutional buying. Currently, FII buying is not returning in India. It will, just be patient. And that is when I think the sentiment shift will happen. FIIs are selectively buying in the market, but they are buying in selective large caps sectors. Those sectors are very clear. It's the financial services, it is private sector banks, it is banks in general. There is some money inflow that is also happening in the chemical and fertilizer space. Metal sector is finally showing leadership. You have to remember that liquidity conditions take time to trigger a rally. This is not an on-off switch that tomorrow, if liquidity conditions ease, right day after tomorrow, the market starts rallying. That is not how stock markets work. This is where your homework also comes into play. That is whether you are in the process of identifying future leaders or not. In Stan's framework, he does not buy cheap stocks. He buys stocks that will dominate the next bull market. And how does he find that? He looks for sectors that are moving up. He looks for which newly listed innovative companies are trying to form a base and move up. I'll do that technical video also for you when the time is right. But currently, you have to understand the broader framework that is at play here. And of course, stay flexible. You can't assume everything in the market or anything that you think is true in the stock market. In the end, if you attempt to buy stocks based on following the RBI, watching out the bottoming out process and trying to identify future leaders, there is a probability, a higher probability that 2 to 3 times you're going to get stopped out because the sentiment remains so poor in the market. And that is the next section that I'll discuss in detail. This is a chart for you I've pulled out of NASDAQ when it moved from something like 1,000 to 5,000 in a span of 2-3 years. Something similar has happened in our market also, where the small cap, mid cap index has gone up 4x, 5x, and then it has started correcting. The reason why Stan has mentioned that sentiment can remain weak for a long time, this chart of NASDAQ actually captures this very well. So NASDAQ went up about 500% in 3.5 or 2.5 years back in 1996 to 1999. And then it fell 80% from 5,000 back to 1,200. Never forget this. Never forget this, because in between, you need to keep a calm head. You don't have to listen to everybody. Open up your charts every weekend and go through the structures and see whether the market is in stage 2, that is moving up, or it is in stage 4, consistently moving lower. If you look at this chart, not once did Nasdaq violate the previous major swing level. It just kept drifting lower, which is why, and mind you, between 2000 and 2002, Fed was aggressively cutting interest rates. So today, if RBI is cutting interest rate, it does not mean Nifty is going to bottom out today and start moving up from tomorrow. It means that irrespective of whether liquidity conditions are working for us, currently liquidity constraints are being removed, RBI is supporting economic growth. GDP numbers are a bit sluggish, but they will improve. Recently, the inflation data was highly favorable, but sentiment remains very poor. This is essentially the formula of Stan Druckenmiller, that is liquidity conditions plus economic conditions plus sentiment. So, what is working for us? Liquidity is working for us. This is 50-50 for us currently. Sentiment is exceptionally poor. And that is why you don't have to be cheeky and start allocating a lot of money in the market. But when you see a rally coming in the market, try and put in some money and test that money out. Whether that particular stock or sector or whichever pockets you're looking, whether that pocket is making money for you or not, and how that pocket is behaving. Always remember, whenever there is a sustainable rally, the leaders will retain the structures and keep going higher. In recent times, defense, railways, engineering, capital goods, IT, these were leaders in the market. Autos, leaders in the market. They kept moving higher. And now these sectors collapsed. Now new sectors are coming in the market. So for market to have a sustainable rally, these newer pockets, banks, finance, metals, chemicals, fertilizers, that is what I can see now. These newer pockets have to take the market higher with strength, and these have to sustain their structure when the market moves into consolidation. Of course, I'll update as weeks progress, but I hope you get the idea. Just because things are aligning in our favor does not mean from tomorrow you start committing a lot of money. Because remember what happened. Whenever things go vertically up, they eventually come down. How down or how low they are going to go, that is something only time can tell you. You just have to be prepared, keep doing your homework, keep looking at structures, and then eventually every week you have to open up your charts and see where the market is going and what it is doing. And I'll again repeat one point. Do not, and I repeat, do not be on social media checking videos and tweets of a lot of people whom you follow who are updating things on a day-to-day or hourly basis. It is not going to help you. The structure of the market is broken. When the structure gets broken, it takes time to repair the structure, and that repairing process cannot be seen on hourly time frame or daily time frame. That repair process is only seen on higher time frame charts. So have a mix of weekly time frame and have a mix of daily time frame. That is the only thing you require. 45 to 60 minutes every Saturday just to go through what the structure of the market is. Cut down that random noise. That random noise is a huge factor when it comes to you getting anxious, putting in money early, and then facing drawdown. That drawdown not only takes money from you, it also breaks your confidence. Never forget this. So, based on Stan's framework, if I have to guess what will happen in the market, then this is what it is. I feel in this particular quarter, markets will struggle. We're already struggling. It's no new news. But I think in the next quarter, we are going to have a rally. That rally can last to about August, September, July. That is something I don't know. But then we will have one final retracement. So this is the rally that we'll have. Then we'll have one final retracement that will head into next year, probably Jan, Feb, March. And that is where I don't know whether we are going to form a new low, but that is where the market will bottom out eventually and start heading higher. Why doing your homework or being consistent today is important, because this up leg you see, the stocks that are going to take the market from here to here, those are the stocks that are not going to come down fully to this level. They'll stop somewhere here, form a new base, and again move up. So that would be a second opportunity for you to add. But if you get shaken out during this phase, then it's going to mess up completely in terms of sectors that were taking the market higher, because the risk reward that is there today, it's not going to come back in this phase of the market. That is what I feel will happen. We are in for the long haul. This is what I feel. Market is not going to start having a secular trend so soon. Economic data will take time to improve. Liquidity will take time to have its effect in the economy. And I think it is somewhere in the first quarter of 2026 is only when we can expect some real solid sustainable trend in the market. By that time also the Trump news, everything will settle down. I also have an announcement in terms of our community. My positional trading community is not a stock tips section. I have to mention this because ever since I've returned to YouTube and started making videos, a lot of people who have joined in and they start messaging me on Instagram saying which stocks to buy or which options to write. This community of mine, and I'll repeat this message for the next 4 to 6 weeks at least towards the end of the video. This community of mine is a positional trading community where nothing is discussed about short term trading, futures, or options. If you're looking to learn about market cycles, picking right stocks, when to exit stocks, then of course this section is for you. There are a lot of experienced traders in this community who are here for the last 4 5 years, who have been following the teachings of William O'Neill, Stan Weinstein, and are doing very well for themselves. So have a realistic expectation. I obviously welcome all of you in the community, but this is a stock forum community where people discuss about stock market. Of course, I guide in general about what is happening in the market. But if this place is expensive for you, then just read the books by Stan Weinstein, William O'Neill, and Mark Minervini. This should suffice. You literally need no course or any other material to succeed. So I certainly welcome all of you, but this is not a stock tips section, and certainly not a section where anything related to short term trading, futures, or options is ever discussed here. So have a great weekend ahead, guys. Take care and be safe.